Let me start by introducing some of our speakers that we have here today. So, firstly, we have Hollie Cho, co owner of Transport Business Advisors of Oregon Central. Hollie specializes in helping business owners sell their companies, grow through franchising, and guiding them to the right opportunities. With her background in banking, project management, sales, real estate, and counseling, she blends sharp business acumen with deep understanding of people. She's passionate about helping owners achieve smooth, profitable exits and empowering new entrepreneurs to realize their dreams. Next, we have Jonathan Cho, the president and lead broker at Transworld Business Advisors. Jonathan brings more than 30 years of executive leadership in banking, wealth management, insurance, and commercial. His expertise and strategic insight help guide business owners through complex sales, acquisitions, and exit planning, always with a track record of driving strong financial performance. And finally, we have Rob, a highly accomplished business broker with 30 years of hands on experience. As a business owner, manager, sales professional, Rob's deep understanding of both the buyers and sellers' perspectives allow him to help clients achieve their transactional goals with confidence and success. We have a chat box open, so feel free to drop your questions in there for the team at any time. We'll also be running a few polls in between, so keep an eye out for that and take a moment to participate and pop up a question at any time. Our panel will walk through your questions in real time, and we'll have a question and answer session at the end. Whether you're just starting to think about selling your business or already in the middle of negotiations, your question is valuable to all of us. So, if somebody's in the room wondering the same thing about selling their business, don't hold back. Get these questions in and let's make this interactive as possible for our hosts. So we're so fortunate to have this powerhouse panel with us today. So let's dive right in. I'm going to leave the floor to Jonathan. Thank you so much for joining us today, guys.
Thank you for
Hi,
having us.
everyone. One of the things that we hope to do for you today is to bring value for your very precious time as being business owners. No one ever tells you to go home after 14 hours of work, right? So we want to say thank you for spending this time with us. Today is meant to be only a very high level overview of the preparation and sale of your business. It is not meant to be a deep dive. If and all of your businesses are unique and different. So if you want a free and confidential consultation, please reach out to us after this webinar. We'd be happy to talk to you about your specific situation. So the perspective that we're going to bring to you is a little wide, from Main Street to lower middle market businesses. So we'll try to incorporate the smaller to larger size businesses because that's the audience that we have. This slide is talking about delivering effective strategies for successful business exits. And I want to focus on what successful is from your perspective as the business owner. And in order for any business, whether it is large or small, preparation is key. We'll go over some of those things that will help you. But let me define success from your perspective. Did you know that according to the Exit Planning Institute, EPI are their initials? I go on their website and learn a little bit about the exit strategy. They did a 2023 survey of business owners, and this is an interesting statistic and why I think you should pay attention to the details. According to the survey, 80 to 90% of the net worth of small business owners or business owners is vested in your business. So when you prepare, as you prepare to exit your business, um, you want to get the best price for your business, the best structure, loan, if you're going to carry a loan or not, bank financing to pay you out potentially 100%, or you may want to define success as you sell part of the business, stay on with a strategic partner, private equity firm, and get a second bite of the apple. So success is unique to your definition of what a successful exit should look like. And whenever you prepare for it, there are many things to consider. So I don't know if you guys have seen that movie Lethal Weapon, Lethal Weapon 2 with Danny Glover and Mel Gibson. Joe Pesci played this attorney. His name was Leo Getz. And his tagline in the movie was, "Whatever you want, Leo gets." Get it? Ha ha ha. What we try to focus on with our clients is our clients' success. And whatever our clients define as their success, well, that's what we get for them. We're kind of like your better looking, uh, maybe more professional Leo gets for you. So to start us off, I'd like to turn to the next slide and ask Rob Radanovich to go forward.
Well, hello, everybody. Nice to meet you all. Thank you for showing up. Jonathan stepped into that first slide, which I think is a very critical one. The importance of early planning really can't be understated. One of the things that I don't think he touched on was, defining a successful exit would be actually exiting without, when you choose to. And businesses that don't make a plan to exit sometimes end up closing, and it's a darn shame. Sometimes, like for instance, on this slide bar, avoiding a triggering event, the third thing. A triggering event could be the necessity to move to take care of a loved one, perhaps an unfortunate health incident or an injury. All those things can change what you had hoped to future to be. So early planning, as it says in the first statement or in the first bar, is very important. You've really got to go ahead and understand, where your business sits in the market, understand your employees, where you want it to be, and then try to chart a course to what you look for as a growth strategy. And that growth strategy can be part of an exit plan. The benefits of planning early, again, it's hard to understate these things. People have different timelines and different goals. And if you understand those, then you should address them by planning early to look for a potential exit strategy. And in the same time, really plan for growth, because a business that's growing is a business that people want. So that's an important part of putting together a successful exit. And then lastly, valuations. There's a really big conversation. And like Jonathan said, this really isn't meant to get into too much detail, but understanding what a buyer would look for. You want to put the buyer's glasses on when you do your employees stay. That's a key thing. If you show that your employees are happy there, that's going to be very important. Strong financials, they are going to help you achieve a better valuation. And there's a number of other factors that we'll cover as we work through this. Back to you, Gene, for the next slide.
Can I just make a comment on an additional benefit of planning early? So not every business, well, there is no perfect business. So if you think you have a perfect business, I challenge to look deeper. IBM isn't a perfect business, but there should be a marrying or a merging of when you're ready to sell with when your business is prepared to sell, allowing time to prepare the quantitative as well as the qualitative aspects of your business can really help you maximize your value and your options when you're ready. So if you have time, it is like Rob said, um, giving it a year or two in preparation can really make a difference. And I'll give you one example. We sold a business that was valued at technology business that we valued at 900,000 in change, and then we worked with them about a year and a half to prepare their operations, their financials, etc. And we went from a valuation of 900 to 2.1 million. And because we had our ducks in a row, we ended up getting multiple offers, but the offer that we settled on was higher than what we went to market with, and we sold it for $2.3 million. So that was more than 2x the original value, and that's at least the financial benefit of preparing early. Okay,
What
Holly?
about the flip side? Oh, I think we did. Okay. So the other thing about preparing early, what's important is the essential steps, right? And what we want to focus on today is the financial readiness. And what that entails is, do you have clean, accurate, up-to-date financial statements? Are your personal and business expenses separated? And then do you normalize earnings by removing one-time and non-reoccurring costs? And you have prepared three plus years of tax returns in key financial reports for buyer review. The other part that we would focus on is the streamlining the operation. This is really important because, they want to see that these standard operating procedures, or the SOPs, are documented for all critical functions. And then do you have a strong management team that will help reduce the owner dependency? And then do you have contracts or licenses and leases that are current and transferable? That is really important too for the sale. The last point I want to touch on is mitigating risk. So what does that look like? So what I wanted to focus on is the diversity of your customer and your supplier base, right? It's important to avoid that over reliance on just a few relationships. So that does matter to buyers. Resolving those outstanding legal, compliance, or regulatory issues is important. And then maintaining a strong reputation, and last but not least, a positive online presence. We can't say enough about that.
Holly, before we jump on to the next slide, just to go ahead and touch on that a little bit, this is why it's so important for business owners to recognize, if they're not familiar with selling businesses at a very personal level, why it's so important to engage with somebody, because you ideally want to have somebody look at your business that has an experience selling a broad range of businesses, as well as something that may be attached to your particular industry, so that you can go ahead and clearly understand the things that need to be adjusted, so that when it comes time for a buyer to look at it, you've dealt with some of these things in advance. Because if you don't start tracking the way you use your personal spending through there, or adjusting it, it could greatly impact the value of your business in a enormous way. And it's very difficult to fix what you've lost in time. So that's why it's important to do that early planning. I just wanted to emphasize on that.
No, thank you for that, Rob. We do have 2 questions in the chat. So I just wanted to stop in. Do you find that most sellers undervalue their business at the start? That's the first question. What do you think?
I mean, if I had to say, if I'm sitting in front of a new client and on the get-go, generally speaking, it's an overvaluation. That would be my experience. But to be the to be the contrarian, I've also sat with folks that didn't see the value in their business, and then they're really shocked. So I see both sides, but if I had to lean one way or the other, I would say the slight overvaluation.
Yeah, I would say the same. The other question, maybe Johnathan, you want to answer, is from Lewis. He says, if my financials aren't perfect, should I fix them before talking to a broker, or let the broker guide me?
So the word fix is interesting to me, but it's preparing them in a way, and preparing your business in a way that gives clarity and transparency to your business. So that's important. And I would consult a business broker, an experienced business broker, to help you with that. In our office, we have offices in California, Oregon, and Columbus, and Ohio. And so we've seen quite a few deals, and that gives perspective. That um, um, gives us a lot of perspective on how to prepare your financials for the sale. So I would invite a good experienced business broker to help you with that.
Just to follow up on what Jonathan's saying, one of the things that's important is when somebody is, we don't fix financials, and I understand where you would come in as an owner and maybe change your recording habits, which could be very helpful. But some of those things don't necessarily need to be, the practices that you have may be fine as is. Part of what we do is we help normalize the earnings of a business, and that's a longer conversation, but that goes a long way into helping an owner get the value, achieve the value in the transaction. And we help them discover what that value is through the process of reviewing their financials and learning about their business. And if your broker's not doing that, then they're missing something.
And then last thing on risk mitigation that I would say is really important is oftentimes there's an over dependence of the business on the business owner. If you can imagine what a buyer might be thinking in that situation is when the owner, how much of the business is going to go away, how much of the sales is going to go away, or what risk are there because there's an over reliance on the person who wants to retire, do something else. So if you have time to cross train and delegate and create an operational system where ideally the owner works on the business versus in the business and creates his or her role such that a new owner can come in with some street smarts, some experience, some understanding of business, and have an easier time operating that business. If everything, the sales, right, sales management, operations is a cult of personality of the owner, well, that puts risk on your business, and buyers are going to mitigate that risk by asking for a lower price oftentimes.
Yeah. Thanks, Jonathan. Katie Scott had a question about how early should I start grooming my business for an exit if I want top value? Well, to answer that, Katie, I think it's never too early. Honestly, you want to have that opportunity to prepare. I say 1 to 3 years, because the last thing you want to do is be forced into selling, and that is going to minimize the value that you'll get for your business. And do you have anything to add, Jonathan or Rob?
I would say that to Hollie's point is as you start preparing in advance, you start becoming able to identify changes in your business. And when you see those things, you might be able to make changes or adjustments that will help you solve these problems or maximize opportunities. Growing the bottom line is an important part of business, but so is stabilizing your revenue streams, working with your employees. Like Jonathan said, sharing, getting redundancies for work, the scope of work that different employees have. All those things are important. And if you plan your business early, and you're basically always ready to sell. So if something happened, everything is ready. And I don't mean you're staged for that person walking in the door at the moment to buy your business. I mean, buy your home at a moment's notice. But the idea is that it's clean, it's tidy, it's understandable, and that's what you want to do.
Exactly.
Yeah, so if you're on this call, I think you're ready to talk to an expert to help you prepare, because it's on your mind, right? And your timeline might be a little bit sooner than somebody who's not on this call. So I commend you for the preparation you're doing through this webinar.
And I just wanted to comment, Adam Hadley, your comment about, the preparing financials really resonating with you, and it's something you wish you would have done years ago. Honestly, we can meet you where you're at and we can work through. So there's always time. And let me see, quick question. So we have another question from Eric. Said, what's the biggest thing sellers underestimate when it comes to preparing for a sale?
Well, I've been talking a lot, but I have, there's a lot of things, but I have an opinion on that. Oftentimes I find that the sellers aren't prepared for the process in itself. There are, there's quite a bit of ups and downs during the process. It can feel, especially during due diligence, like, very invasive. Why are they asking me that question? Don't they trust me? Man, that's, death by 1,000 questions. And then you get into the lending. Why do I have to give that information again to the lenders, etc.? So the process can be a little taxing. The biggest thing I would say that if a seller has something that they're looking forward to doing after they sell and have a true understanding of it, they tend to be a little bit more resilient in my experience of the process. But the process can be lengthy. You can get an offer. The offer could fall through for, during the negotiations. So the process in and of itself. And again, that's why I think we all think, whether it's us or a qualified, experienced other broker, can be very helpful to help navigate through those complexities so that you can take this very complex process to make it as easy as possible and less taxing.
Just to kind of bring that in a nutshell from my perspective, reviewing the business, planning in advance, looking for the possible problems that you're going to have, the concentration issues, understanding them, documenting them, keeping your financials in order. And then the most difficult thing that I see is them really understanding the complexity and the difficulty of the due diligence process. And that's where the planning helps to solve that. Because if somebody's reviewed your company, they understand it, they've helped you prepare yourself for getting your financials, your house is in order, then the due diligence process can be much smoother and can be much more effective and can help you achieve a better sale price as well.
Yeah, well said, Rob.
Can I just, I know we got time limit, but one of the things that we say all the time is we need to get ugly early. And what that means is we need to understand the good and the bad and the ugly. There is no perfect business. If we identify the challenges like concentration, some of maybe operational situations, and we present that as a challenge that the business has, then the buyers, that establishes trust and confidence with the buyers. So having a real deep dive conversation and presentation of the good, the bad, and the ugly ultimately will make the process smoother and really get you more for your business.
Exactly. Jean, can we go to the next? So with this, I want to continue on to the key strategies for the operational readiness, right? What does that mean? So internal processes, make sure, like I said earlier, have your standard operation processes in place. Your SOP should be documented. That's going to help you with the readiness of your business. Make sure that you're in compliance, so you can conduct quarterly audits on your requirements, industry certification. That's today. Keep your contracts current. I think that is really important too. What that means is reviewing and renewing any supplier agreements that you have and making sure that you have favorable terms in place, because that is, again, very important for buyers. Team structure, what does that mean? Do you have defined clear roles and responsibilities? Do you have updated job descriptions? And org charts are really important if you have that in place. Do you have a good leadership team, and do you have a senior manager who can oversee your day-to-day operation? That will help take you out of the business as well. And then just make sure, retain top talent. That's really important. So if there's some type of implement like a performance-based bonus or profit sharing plans, that's always helpful in retaining your employees. Next is the succession planning. So do you have any potential successors? For example, current operations managers, any key management team member, any GM role? Do you have a leadership transition plan? So that's important too, where maybe you can outline a timeline, some training milestones, and some responsibilities clearly defined, and then communicate the plan. So share the transition roadmap with employees or stakeholders if those are the individuals that are identified. The next one is reduce reliance on owner. I think I touched on this earlier, but it is really important that delegating decision making. So you empower that department head or that manager in place to help approve purchases or, just take on that day-to-day operations. Implement maybe performance metrics. So then, for example, you can track the KPIs for them, like the sales conversion rates, production time, to make sure there's efficiency. And then building customer relationship. So that's another point where buyers would ask, is that relationship reliant on just the owner? So this is a good point for you to introduce that relationship to a key manager or other employees, so the business is not just dependent on you. Rob, do you have any thoughts?
All those things are so to the point. Just to add something that's actually ongoing, I'm currently working on a project, and one of the things that I love to hear, which was outstanding, was I heard the private equity firm tell me that the client that I'm working with has now set the new bar at how excellent the business was put together. And I can't tell you the confidence that gives me in the deal, making it to the finish line. And it has to do with somebody that was prepared early on. We met 3 years ago. So you take planning and you add a very competent business manager, and you're going to get an excellent outcome. It cannot be underscored how important it is.
Yeah, and that's a great example, Rob. We have another question from Alicia. So her question is, are there ways to identify serious buyers early so then they don't waste time on tire kickers?
Well, if I was going to take that question, I would say that hopefully your broker has got a good feel for who they're dealing with. The process that we employ will ask for details from buyers as they have to sign a non-disclosure agreement. We're not going to share our clients' information without some protection. But if they understand sales and people and they have good working relationship, hopefully they can sniff out the ones that are the good fits. And actually, if a sell is well prepared, I've found that oftentimes I just go right to asking for it's called an indication of interest. That is asking for serious people to make serious suggestions on what they're ready to do. And when you time it right, oftentimes you can get multiple offers on the table for our sellers to review to see who they want to have a conversation with. It's part of that sniff test, if you will.
That's a good point, Rob. Glenn appreciates your real world example. So that was greatly appreciated. Katie Scott has a question. How do you handle the intangibles like brand reputation and valuation process?
Intangibles are a very difficult thing. And it really depends a lot on the type of business that you have, where you're positioned in the market, your gross revenue and what have you. On a larger, more mature business, with strong gross revenue, strong brand recognition. We'd have to look at a number of factors. It's probably hard to use a broad brush on that, but they are very important. A business that's been around a long time is very important. I actually have specific buyers that I'm working with that they're looking for businesses that are over 30 years old. That's important to them. So there's a value to specific buyers. To other buyers, they're really looking for cash flow. Johnathan, I'd love you to add your thoughts on that. Excuse me, was that Katie? Katie, I think it would be great for a question like that if you would, reach out to Hollie or Johnathan or myself, because I think that's something that to really understand it, you almost have to have more specifics, but they are very important. Intangibles do matter. Patents matter. Trademarks matter. History of a business, the length of a business, the customer base, what are their records like? There's a million factors, and all of them, sometimes the beauty is in the eye of the beholder. One particular individual might look at that as a critical buying decision tool, but the next one might just pass right over it. So what we try to do is, as we learn about your business, we try to emphasize the value that you've created, and I think that does build a stronger valuation and stronger offers.
Yeah, that's a great point, Rob. So Lucy has another question. How do you balance giving enough information to attract buyers without revealing too much too soon?
So how I would take that as far as giving too much information early. First of all, if you're planning on running the sale yourself, I see sellers decide to hand out information early. It stalls the process. It scuttles the deal often because they've not delivered the information in a way that it is easily understood. So it's a common problem. When we get involved, what we try to do is accurately normalize the income statements. And that is done. Sellers go ahead and they review that and they approve it, because we are actually supporting your sale of your business. It's not my business. But we help you because that's what we do. So we help you put that together. And then we want to go ahead and give the buyer a clear picture of not about the specific customers of the business, for instance. That would be something that you just probably wouldn't share until later in the process, long into the process after a price was agreed to. You would want to go ahead and really mitigate the damage that could happen to a business because you've shared information early. So generally speaking, after an accepted offer, key metrics of the business might be shared. But in the preliminary stages, normally you're going to put together a confidential information memorandum, which is going to break down the most important points of the business, because we're trying to help you find the right buyer, and we need to share important details, but we don't want to share sensitive details that could damage your business. So that's generally how that's handled, and every business is different. So I'd have to know more about that business before I could give you specific recommendations.
Again, another question from Fiona. How early should I start grooming for an exit if I want top dollar? And earlier we did answer this question. It's never too early. We typically say 1 to 3 years, but wherever you're at, we'll meet you there and we'll help you prepare for your sale.
If I can chime in on that, Hollie, there's some things that are really interesting. I would assume that many of you out there are business owners. And since I don't know who you are, I would bet that some of you just fell into that role as a business owner. You might have started out working for somebody. Maybe you were a top salesperson, or maybe you were just brave enough to get out there and take a swing at it yourself. You might have some business background. You might have some education, or you may not. You might be a blue collar worker who got tired of the boss and decided to start your own business. And after 20 years, you've done what works, you've built amazing relationships, and now you have a killer business, but you never really did understand how somebody else might look at the value of the business. And when you ask how early should you start grooming your business, one of the things that I think is just critical is that if enough information is available. Years ago, when I started in business, we didn't have the tools that are available today to record the information in the way that you can today. For instance, customers, how much work you do with a specific customer, what the SKUs are that you sell, the particular services that you provide, how to break all these metrics down, understanding what a buyer might look for is very important. So meeting with somebody, even if it was a consulting agreement that you had, that they came in and helped you set your business up for a future exit, even if it was a decade down the road, if you could establish that early in your growth stage for your business, and you just follow up on these practices year over year, your business will be so far ahead of the average business when it comes time to sell. It's certainly worth considering. And I love that question, to be honest with you.
Yeah, that was the problem. What about, so I guess the slide, since we can't hear Johnathan, ensuring financial readiness for big business exit. So some key points to focus on, I'll just briefly touch on them. Recasting financials. That's what I discussed earlier about normalizing your numbers. So what we do is we analyze the last 3 years of your financials, and we do an assessment on your financials. We look at what are one-time expenses, non-reoccurring expenses that we'll add back. What we're trying to achieve there is to determine what the cash flow of your business is, and then presenting clean records. Like I said earlier, it's important to have accurate financials. Make sure that you have them file taxes available, and you.
So yeah. The key to what this slide is all about is really normalizing your earnings. And what that means is, oftentimes in the last note here at the bottom, there's EBITDA, SDE, and earnings in general. EBITDA is earnings before interest, taxes, depreciation, and amortization. SDE means seller's discretionary earnings. And in most medium to small businesses, the seller discretionary earnings is going to be an absolute focus point for a buyer. So understanding what that is and making sure that you've structured your pay in a way that honors your business when it's reviewed by a buyer. Oftentimes, a seller may decide to take a very high salary. And in theory, that hurts their EBITDA number. Now, in a business that's a more mature business, and you're looking for, let's say it's a $5 to $10 million exit, those businesses are often viewed under EBITDA. So that recast of the financials, the review of the way the financials are put together is just key. Establishing a solid performing EBITDA year over year with consistency, and then us normalizing it. And what that means is accounting for unusual things. Say, for instance, you had a fire and your business burnt and it was damaged, and you paid your employees for 3 months while they repaired your building, and it damaged your business. Understanding how that one-time event hurt the earnings of the business, so that we can explain it, so that 2 years down the road, when you go to sell, somebody says, well, I'm afraid that that's going to happen again. And then they realize it's a fire, what it actually cost, what the business would have likely made, how the effects were. Those are all key things. And having a skilled broker and somebody that understands business in general and your business, and helping them through that process is a key part of preparing your business for sale and normalizing EBITDA and SDE earnings.
Yeah, that's a great point, Rob. Jane, can we go to the next slide? So, Rob, this is understanding your business valuation and what are the key drivers.
Well, I know Johnathan wanted to tackle this one, but I'll see if I can.
I'm sorry, guys. I don't know what's going on with my computer, but valuation piece is very important. And there are a number of ways that we value your business depending on what your situation is. So on that piece, it's important to appropriately use the right method in valuing your business. So on Main Street, smaller size businesses, we normally go to market using market comps. And when we do the financial analysis, we compare where other like businesses have sold. That only gives us a range. And that process of the financial analysis and range finding is relatively simple, as long as you do it properly. And there is a lower, medium, and high range that businesses have sold for. So that's the capital markets determining what a plumbing company should sell for, or what range they should sell for. Now, we talked about qualitative ways to value your business, how much concentration, employee turnover, just these qualitative strengths or weaknesses of a business. That really takes a skilled, experienced person to determine where, if you're going to go to market with a price, you want to go to market with, so that you can try to get the top tier of what your business can sell for. So that is a methodology. At the end of the day, all businesses, NVIDIA, IBM, they have a PE ratio, price to earnings ratio. It all comes down to a multiple of the earnings, right? And then the better they see the future, the better the growth rate. That is a very subjective thing. You're not going to have a million investors making that decision of the stock price or the price of your business, but it kind of plays that way. The one of the other things that can determine value as well, and is maybe it's better to go to market without a price. And again, the answer is really how it applies to your business is it depends. But the size of business and the audience of buyers that we're trying to reach can really determine that. So if we go to market with without a price, then we let the market decide. And the market, there, you only need one person to buy your business, and there may be one business out there that is willing to pay more. So we had a business, a colleague of ours had a business. They valued it at $14 million. Well, when they went to market, they identified strategic buyers, private equity, and ultimately that business sold for $36 million, right? So it really depends on your situation, what approach we're going to take. But the most important thing for you in getting the best price and structure for your business is, in my opinion, planning with an experienced, knowledgeable professional in the industry, because we could help navigate those things. And then some of the value drivers that impact your business. We talked a lot about those. Good books and records. Is there redundancies in your business? Is the business over dependent? Is your business consistently growing? Do you have the operational efficacy to grow? So those are the qualitative pieces that can make a huge difference, whether you get a 1, 2, 3, 10 multiple for your cash flow.
No, thanks, Johnathan. That was a clear clarification. Jean, can we go to the next? So this is where we're talking about identifying those deal killers in business transactions. This is important to know. And I'm just going to briefly go over this, but high level, are there any pending lawsuits, right? Are there any ongoing litigation? Because that's going to create uncertainty and potential liabilities for your buyers. Messy or inconsistent financial records. I know I feel like I sound like a broken record, but it is really important. So inaccurate, incomplete, poorly organized books, it does undermine the credibility, and it's going to make due diligence longer and more costly. And also your buyers are going to question like your management quality, your business in general. The other deal killer is over dependency on just a few clients. Again, we talked about this, but it's important to diversify the concentration of your customer. Lack of clarity or ownership agreements. So if there's unclear or disputed ownership, issues with shareholders or partners, operating agreements should be intact and clearly defined. If there's inconsistent intellectual property, so buyers are going to fear like post-sale IP issue. These are for larger companies. And then if there's employee agreements lacking clarity, we discussed that again. It's important to have those contracts in place. If you're missing non-compete or solicit or, confidentiality clauses can really threaten your workforce.
Holly, I want to add one thing to that, and I know we're running long on time, but on number 4, lack of clarity of ownership. In this short seminar, we didn't go into the difference between an asset sale and a stock sale. A stock sale is essentially when somebody buys the actual company itself, the entity. Having a clarity of ownership means, you need to have your articles of incorporation cleaned up. If there were changes made in ownership over the years, they need to be reviewed by an attorney in advance to make sure that there's not going to be a problem. These are all things that your broker should be helping you with pre-sale as you look at the possibility of a stock sale versus an asset sale. And there's a number of other factors, but I just thought that was an important one. Sorry about that, Holly.
Oh, absolutely. I think that's a great point. Jean, can we go to the next? So this one, we're kind of along the same line of avoiding common business exit or pitfalls. Again, I'm going to go back. I'm stressing on the owner dependency issues. It's really important not to have that heavy reliance on the owner, especially for the daily operations, because it's going to reduce the buyer confidence. So unrealistic pricing, I think we talked about that earlier, and there was a question about overpricing. Overpricing does deter serious buyers, and it will prolong your time of the business being on the market. So it's important to get a professional business valuation. And, we offer a broker opinion and value based on market comps, earnings, and your industry trends. Legal surprises, make sure there's no unresolved disputes, unclear ownership agreement, like mentioned earlier. The other one is emotional decision making. This one we do see from time to time. Sellers sometimes reject good offers, or you make rash decisions based on the sentimental attachment. We get it. You put your blood, sweat, and tears into your business, and it's, a great business that you built. However, prepare emotionally to pass on that baby, right? Define those clear exit goals and rely on the data and, advisors like us to help you guide through that negotiation. Poor exit strategy planning. Last minute exit often result in lower sales prices and unfavorable terms. And that's why we stress the importance of preparing early, 1 to 3 years in advance, just so we can address or identify any opportunities where we can help you work on improving those value. And neglecting due diligence preparation. This is really important because due diligence can go from 15 days to 30 days. And disorganized records, like we said, will slow down the process. It'll frustrate your buyers, and it will also cause the deals to collapse or die. So it's important to prepare those due diligence folders, clean financials, contracts in place, leases, operational documents for review. And this is where brokers like us can help with that process. Next one, Gene.
Identifying buyer types.
Okay, so depending on your specific business, there are generally 3 audiences that we look at. The first are the individual buyers who want to leave corporate America, start their own business. Generally, what these folks dominantly do is go from one job where they're working for somebody else to buying a job. That's kind of how they look at it. And this is the majority of Main Street businesses. Sometimes it stretches into the lower middle markets. The others are strategic buyers. They may be your competitors wanting to grow through acquisition. It may not be your competitors in the same geography, but somebody who wants to expand through acquisition. Those are strategic buyers. Strategic buyers usually can have synergies. So they're oftentimes the best priced offers. Then we have family offices and private equity groups. They're dominantly financial buyers and the financials and the returns are most important, that is a group that scrutinizes the business sales process the most. Regardless of the audience that we pursue for you or a good broker pursues for you, we have to tailor the message to that audience that's appropriate for your business and to capture that specific attention of the buyers who are looking for a business like yours.
So next slide, Gene.
Planning early to exit. Understanding what a buyer would look for, keeping things tidy. Understanding who the buyer types are, like Johnathan said. Depending on the size of business you have, it could be a corporate America individual, somebody that's stepped out and decide they want to run their own business and control their future. Right now, that's quite the trend. Private equity, they're often looking for medium to medium large size businesses. There's family offices, there's long-term offices that are out there. There's plenty of opportunity there. And to get those to the finish line, that early exit planning or early planning your early exit is very important to have everything maintained. Financial records, a huge part of success is going to be keeping your documentation clean and understanding that you have the right information available for the broker to help you present your business in the best light. So at least 1 to 3 years out is fine, but sometimes people need to sell sooner. So get a look at it when you can, if this is something that you're planning for. Maximizing the business sale. Having your business put together in running a great business doesn't mean that all years are trending upward. Sometimes identifying trends or expected trends and picking an exit time based on your business, not on your timeline, might be something that you want to consider. And to do that, you really need to have an understanding of your earnings, where the money's coming from, why it's coming from, and really reviewing it with somebody could be very helpful. But essentially, the idea is that just because you want to sell now doesn't mean it's the right time for your business to sell. So you got to think about that too. Facilitating due diligence, the accurate records and the gathering of the correct information, having it prepared and ready so that a buyer that does make an offer can quickly understand that you have a well thought out, very thoughtful business that is ready for a new owner to step in where the old owner didn't do everything, because that can make things very difficult and hurt valuation. Next slide, Gene. Well, that gets us to the end. Those are just some testimonials with clients that we've worked with in the past. I hope we can have a few minutes for any additional questions, Gene or Holly.
Yeah, so Matthew has a question. How do you handle situations where the buyer wants to change the deal terms late in the process?
Well, those things really you need to look at those individually. And sometimes there's reasons why the buyer is requesting a change. As an example, quickly, say there was an accepted offer on the table for $1 million. And during the due diligence process, they find 30 days, 45 days into the process that there was some errors in accounting. And those errors in accounting hurt the earnings of the business. So, for example, the $1 million was based on a 4 multiple of $250,000 of earnings. And let's say that the actual earnings were 225. A buyer might say, look, we still want to buy the business and we're going to give you the 4 multiple, but we need to base it off of the $225,000 because, it's not our fault you had an accounting error. That's just why it's so important to have your books tidy. And depending on that, there could be a compromise made to get the deal done. But those are challenging times. There's no doubt about it.
Yeah, that's a great point, Rob. And then we have another question. When buyers push for seller financing, how do you protect yourself?
Hire a broker. That's what I got to say.
So sometimes it may be advantageous for the seller to offer seller financing, but and sometimes the banks may require it as part of the deal. But here are some things that we work with your attorneys to make sure are in place. If you're basically going to be a lender at that point. We encourage you to understand their financial books and records too, just like a bank would. So a credit report, we ask that a credit report be produced so that the seller can review that. We also ask for a PFS, personal financial statement, that shows the assets and liabilities of that business. We may ask for information if it's a husband and wife. Is one of the spouses going to continue to work while the other operates the new business? We try to give a comprehensive 360 view so that there are, what you're getting into. Then some of the other things that we'll work with are security instruments. And an attorney really does that. But personal guarantees are, I've never seen a seller loan be given to a buyer without a personal guarantee. Then there are different types of liens depending on the buyer situation that we can work with the attorney to put on. So, let's say that somebody has equity in their home or a rental property that could be the difference between whether the deal goes through or not. The seller may feel comfortable. You may feel comfortable. Let's say that there's $500,000 worth of equity and you're in second lien position and the note is for $100,000. That could make a big difference to whether or not you say yes. But probably the best way that we protect our sellers is by doing what we do best, by bringing a lot of buyers, creating competition so you have choice in the buyer that you ultimately choose. And that oftentimes allows us to provide backup offers in case the other deals fall through. And ideally, you will have multiple offers to choose from, and you can choose the strongest one.
I think the next slide has our contact information, Jean.
Yeah, we can put that. And that's a wrap. If you want to know more information about what we've discussed, we can go into details. Give us a call for a free consultation. Or if you just want to have a conversation just about anything, Rob loves conversations about everything and anything.
Yeah, it's a problem. I'm sorry in advance.
Thank you all for joining us today. I hope you found it.
Appreciate it, everybody. Take care.
Thanks, guys. You were awesome. I see there's a lot of people asking when's the next session. They definitely want more. This is the most practical advice I've heard in any business webinar. A lot of thank yous coming in. We'll be sending out this QR code to the free valuation, as well as the panel of speakers contact details on the email you'll be receiving tomorrow with the recording.